that later. Now, they incorporate ideas from many other sources, including Irving Fisher, and I emphasize Fisher here because one of the two major strands in modern post-Keynesian economics does have a direct lineage back to Fisher. Now, Fisher, when he back in 1929, was the world's most famous neoclassical economist, and rather like the world's most famous neoclassical economist today, Paul Krugman, he was a columnist for the New York Times. And actually speaking at an event which was reported in the paper on October the 15th of 1929, he made the statement that stock prices have reached what looks like a permanently high plateau, so they're not going to fall. This is the way that the headline was shown in the New York Times itself. And he said, "I do not feel there'll be ever a 50 or 60 point break below present levels, such as was being predicted by one of his newspaper rivals who was a stock market bear." And he said, Fisher said he expected to see the stock market a good deal higher than it is today within a few months. Well, that goes down as one of the world's most prominent bad predictions, because just a mere 8 days later, the Dow Jones lost 10% in a single day, which was on the way to being almost half of what Babson was predicting happening in a single day. And over the next few years, actually very rapidly, given the fact that he was so highly levered, he lost $12 million, which is a substantial sum. Let's put that in modern terms, roughly $110 million US dollars today. And of course, as well as losing money, he lost his reputation. These were trotted out to him. When you search for Fisher's name, these quotes are the main things you'll find on the internet. And he's wiped out mainly because his wealth was levered using margin loans. Now, what you do with a margin loan is you put down a deposit, and back in those days you could put down a 10% deposit. So say in his days, when he did his margin borrowing, it would have been, say, $10 million. And with that, you buy $100 million worth of shares. That's where your net worth comes from, apparent worth comes from. Now, if the shares go up by 10% to 110 million, you make 100% profit on your $10 million deposit. But if they fall, which they did in one day by that 10% amount, on a margin loan, you are required to maintain the value of the portfolio at least the initial level. So it was worth 100 million, they've gone down to 90, you have to put in $10 million to top it up. If you can't do that, you go bankrupt. He didn't quite do that. His wife's sister, who was quite wealthy, rescued him from absolute bankruptcy. But in the aftermath to all this, and first of all in total disarray and confusion, he ultimately developed an alternative theory to explain where the crash came from, which he called the debt deflation theory of Great Depressions. And he argued the two dominant factors that cause depressions are, quote unquote, over-indebtedness to start with and deflation following soon after. And intriguingly, he's nothing like a writer like in Keynes's class as a writer, but I find these lines quite poignant because he's really talking about his own experience. So he ruled out the importance of other factors like over-investment, over-speculation, etc., etc., because there'll be far less serious results when they're not conducted with borrowed money. And believe me, he knew about borrowed money. So that is, over-indebtedness may lend importance to over-investment or over-speculation. The same is true as overconfidence, and he clearly suffered from overconfidence before the crisis. This is a wonderful line. "I fancy that overconfidence seldom does any great harm, except when, as, and if it beguiles its victims into debt." And he was clearly a victim. Now, his post-crisis theory was this idea of having too much debt combined with low inflation or even falling prices. So he said, in that situation, the first thing that will start happening is debt liquidation. You have distressed selling to try to cover your debts, which contracts the deposit currency because as you pay bank loans off, you reduce the money in supply and circulation, which is an extremely important point. And the velocity of circulation also slows down. That means prices fall, and unless you have reflation being brought in, which of course we're talking about again today, then you have a greater fall in the net worth of businesses, causing bankruptcies, a fall in profits, which means those concerns reduce output, sack workers, more bankruptcies, etc., etc., leading to pessimism and lack of confidence, which means hoarding. People slow down the rate of velocity of circulation of money even further, and you see complicated disturbances in the rate of interest. So a fall in the nominal rate, but a rise in the real rate, as you've seen from the data, or you will see from the data in this lecture. Now, this argument Fisher put forward was fundamentally and explicitly non-equilibrium, and this is what is missed by neoclassicals when they read and either fail to interpret or completely dismiss Fisher on this point. he starts by saying that we can tentatively assume that most variables in a general way tend towards a stable equilibrium. Therefore, unless there's some other disturbances, they'll progress towards equilibrium, just like a rocking chair. Once you set it in motion, will ultimately stop moving. He said, but the exact equilibrium sort is seldom reached and never long maintained. New disturbances are, humanly speaking, sure to occur, so that therefore any variable is above or below its ideal equilibrium. And he said, therefore, theoretically, and in fact factually, there must be over or under production, over or under consumption, over or under everything else. And the lovely punchline at the end, it is as absurd to assume that the variables in an economic organisation will stay put in perfect equilibrium as to assume that the Atlantic Ocean can never be without a wave. So here is an argument: you must model the economy from a non-equilibrium point of view.